All right, so here we begin. My name is David Kuenzi. I am the founding partner of Thun Financial Advisors. We are an investment management firm in Madison, Wisconsin, working with expats all around the world. And today's topic for our webinar is going to be tax and investment implications of Obamacare for Americans abroad. So I'm going to get right into it. And again, if you have questions or if you have any audio or video problems, please type them into the chat box on the monitor so that I'm aware of it as we move forward. All right, today's outline is going to include a little background to begin with about Thun Financial Advisors. Then we're going to go on and talk about the 2013 tax changes, the Obamacare tax changes, and other tax changes. Then we're going to be talking about specifics of these tax changes that are particularly relevant to Americans abroad. And then finally, in the last section, we're going to talk about investment and tax planning strategies to respond to the new tax environment so that we as investors, as Americans living abroad, can maximize our wealth potential and build financial security for ourselves and our family over time as efficiently as possible on an after-tax basis. All right, a little bit more on Thun Financial Advisors for those of you who are new to us. We are an investment management and financial planning firm. We are a fee-only U.S. registered investment advisor. And if you're not exactly sure what fee-only means, please check with us. It's a very important aspect of the way we operate, and I'd love to have the opportunity to explain how that works. Our client base is global. About 90% of Thun Financial Advisors clients reside outside of the United States, and on average we manage a little bit over $900,000 per client. All right, I have a disclaimer I'm going to read through. It's not just here for legal reasons. It's an important disclosure in terms of thinking and understanding what we're talking about today. So I'm just going to read this. This presentation addresses certain aspects of recent changes in U.S. taxation of investment income. It does not constitute a comprehensive review of all recent U.S. tax changes. Furthermore, all references to non-U.S. taxation are incidental. No taxpayer or investor should rely solely on information provided in this presentation to make tax or investment decisions. Thun Financial Advisors does not provide tax advice. All discussion of the taxation is a function of investment and financial planning strategies recommended by Thun Financial Advisors. Information herein is gathered from sources thought to be reliable. All investors and taxpayers should consult qualified tax specialists for advice on their tax preparation needs and the application to their situation of any strategies described herein. So obviously this is a very complex area. We're focusing here on U.S. taxes, but your U.S. taxes cannot be fully understood without a greater comprehension of your local tax situation in the country of your residence. And obviously there's a lot of interaction between local taxes and U.S. taxes. Obviously, given that we're dealing with a global client base here, we can't address all the local issues. So it's very important that you understand the disclaimer with respect to this only pertaining to U.S. taxation and not therefore presenting the full picture of your tax situation as an American living, working, earning, and paying taxes abroad. All right, with all that said, let's dig right into the salient issues. First of all, the specifics of 2013 tax changes, both the ones that are specifically related to the Obamacare legislation and other. There are basically four new taxes we need to cover. First is the new 39.6% top tier tax bracket. Then we're going to talk about the higher investment income tax rates that will apply for taxpayers who find themselves in this highest new marginal tax bracket. And then we're going to move on to the Obamacare taxes, which include a 3.8% Obamacare net investment income surtax and a 0.9% Obamacare Medicare tax. Now, throughout this presentation, I refer to Obamacare. Of course, Obamacare is the colloquial name for the ACA legislation, the ACA being the Affordable Care Act. It's not meant in a pejorative sense. It's used generally in the United States now to refer to this legislation, and in no way implies any political view on the policy of Obamacare. We're only here to explain the implications and help our clients and our followers make the best choices possible given the new tax environment in which we find ourselves. All right, so let's talk about the first set of tax changes that came about in 2013. That is the creation, highlighted here in red, of a new top tax bracket. It used to be that the top federal income tax bracket was 35%, but now for the wealthiest Americans, there will be a new 39.6% tax bracket. And you can notice down in red the thresholds above which income is taxed at that level for a variety of filing status. For married filing jointly, maybe the most common filing status, you have to have over $450,000 of income for your income to be subject to this new 39.6% tax. But the changes did not end there. First also I want to highlight the married filing separately category, and notice that the threshold is a very low $225,000. And the reason I point this out is because while this filing status, married filing separately, is very rarely used in the United States, it is somewhat common among Americans abroad who find themselves married to foreigners, non-resident aliens, and in the process of not wanting to bring their spouses into the U.S. tax system, have chosen not to file married filing jointly, but to file married filing separately. This is quite common. The problem with it is now, from the point of view of this tax and other taxes we're going to be discussing, is the threshold above which these new taxes are imposed for this filing status are, really quite low, $225,000 for the new 39.6% top tier tax bracket. Now, the other change that was not specifically related to Obamacare, but has a significant impact on investors, both in the United States and outside the United States who are subject to U.S. taxation, is new higher tax rates for investment income for those who are in the top tier, top new 39.6% tax bracket. And as you can see here, as you can see here, highlighted in red, all of those above the threshold specified there are now subject to a 20% tax on long-term capital gains and qualified dividends. This number, of course, used to be 15, and for those above these thresholds, it remains 15. Again, these three numbers represent the thresholds for the three filing statuses that we're going to be discussing. Married filing separately, single, and married filing jointly. All right, and we'll come back to the importance of thinking about those different filing statuses later in the presentation. Now, the next two changes are the changes in taxation specifically related to Obamacare. The first and most important one is the new 3.8% tax on net investment income for taxpayers with, again, these thresholds 125, 200, and 250 of modified adjusted gross income. The other new Obamacare tax that is specifically a result of the Affordable Care Act legislation is a new Medicare tax. It is an additional 0.9% tax added to the existing 2.9% rate that is applied to all so-called Medicare wages, which is typically earned income, wage income. And it is applied to all those Medicare taxpayers who have wages above, again, these thresholds, $125,000, $200,000, and $250,000 for the three filing statuses we're discussing today. Okay, now, if we take the new changes in the taxes, the top tier taxes, the increase in the tax on investment income, as well as the new Obamacare net investment income tax, you can see the combined new tax rates for all categories of investment income are highlighted here in red. Where it's black, these have not changed, so if you're below these thresholds, the rates have not changed. But for anyone earning above these thresholds, in the red, you can see a substantial increase in both the long-term capital gains rate, the qualified dividend rates, and then, of course, all types of other income, including such things as non-qualified dividends, royalties, rents, taxable interest income, and so forth. For a highest possible rate of 43.4%. Now, note here, however, that this is just talking about the tax rates on investment income. Aside from this, which we're not addressing here, are just the higher rates on regular income, and of course the higher rates imposed as a result of the Medicare tax, which does not directly affect investment income. All right, now what is the net effect in terms of the bump up in the rate of taxation for investment income? Okay, you can see here it's pretty substantial. Long-term capital gains for people in the top tier tax bracket have risen 59% between the two additional taxes they're having to pay. Qualified dividends also 59%, and other investment income is up about 24%. Okay, so let's imagine a kind of a fairly typical scenario for a couple of U.S. expats living abroad. Maybe both spouses are working, they're married filing jointly, they have combined income of about $500,000, or in the case of an American whose spouse is not reporting to U.S. standards and hence he's married filing separately, this scenario would be applicable for a much lower threshold at about $275,000 of taxable income. Then imagine in either one of these scenarios you have about $45,000 of net investment income, and that's made up of a kind of standard mix of investment interest income, qualified dividends, non-qualified dividends, and long-term capital gains. The tax bill on that $45,000 of investment income under the old tax system would have been about $8,500. Beginning in 2013, with the new taxes that we're talking about here today, the tax bill just on the investment income portion of the taxable income is going to be $13,450, about an additional $500, or net about a 41% tax increase on investment income in 2013 versus what it was prior to that for people at these upper levels of income. All right, now given that layout of the taxes we're talking about as it affects investment income, let's talk about some of the special considerations that you as an American expat living and working abroad have to be aware of with regard to these new rules. Okay, first of all, let's be clear, the 3.8% Obamacare net investment surtax applies to all investment income no matter where it was derived and where the U.S. taxpayer was resident at the time that they earned the money. Whether or not you have any benefits accrued from the new Obamacare legislation domestically in the United States, you as a U.S. taxpayer must still pay the taxes associated with it. Okay. With respect to the Obamacare Medicare tax, okay, who is subject to this Obamacare Medicare tax? Well, basically, if you find yourself paying U.S. FICA, which is Social Security and Medicare tax, whether you're in the United States or outside the United States, then you're going to owe this additional 0.9% tax if you are above the applicable threshold. Now, many Americans outside the United States are not paying Medicare taxes, especially if they live in one of the 24 countries with the U.S. totalization agreement and in some other cases. But many Americans, for a variety of reasons, do find that even though they're no longer living in the United States, they continue to pay Medicare and Social Security, and therefore they will be subject to this additional 0.9% tax, again, if they're above the applicable threshold. Now, with respect to the thresholds for the Obamacare 3.8% investment surtax, you have to recognize that when you look at the threshold, which is calculated as modified adjusted gross income, the M in modified adjusted gross income refers to a variety of things, one of which is the inclusion back in to the calculation of the foreign earned income exclusion. So if you're familiar with how your U.S. tax flow works, one of the ways that most Americans living abroad will reduce their U.S. or eliminate their U.S. tax obligation is to apply a foreign earned income exclusion credit. Well, this has the effect of reducing significantly your adjusted gross income. For the purposes of figuring out whether or not you owe the 3.8% Obamacare investment income tax, be aware that you're going to have to add that back in, and that's going to make it much more likely that you're subject to the tax. Okay, and finally, again, let's be clear, the 3.8% investment income tax, as with other taxes we're discussing here today, do not apply to non-resident aliens. So non-resident aliens who have investments in the United States are generally not subject to capital gains. They may have withholding on dividends and interest. None of that is affected by any of these new rules, and it does raise the option that we're going to discuss later in the presentation about gifting assets to spouses and others who are outside the U.S. tax system and therefore not subject to any of these particular increases in tax rules. All right, so now let's go on to another couple notes here with respect to Obamacare and Americans living abroad. And these are really, I think, the two most important ones that have to be understood for people who have income levels at which they're going to be subject to these new taxes. The first one is that the 3.8% Obamacare surtax on investment income cannot be offset with taxes paid to a foreign government on the same income stream. Okay. If you're, again, familiar with your tax preparation flow for U.S. tax purposes, most Americans, especially upper-income Americans whose income exceeds the foreign earned exclusion limits, will typically use a foreign tax credits gained from the fact that you pay taxes on the same amount of income to foreign jurisdictions to use those as credits to offset the taxes you would owe in the United States. Unfortunately, and this ruling was, this was much discussed and people didn't know how it was going to go, but the IRS just ruled on it this past summer and said the Obamacare tax is a surtax. It is not an income tax, and since it is not an income tax, you cannot use a foreign earned income tax credit to offset it. Hence, clearly, Americans abroad who owe this tax are going to be subject to double taxation. Whatever tax they pay on the same income stream to a foreign government, they're still going to have to pay tax to the U.S. government no matter what they've already paid someplace else. This, I think, is one of the most obvious improprieties, unjust applications of these rules with respect to Americans abroad, because clearly it's a case of double taxation. And the other one that I want to highlight that I've already mentioned a couple of times is the fact that with respect to the new top-tier tax bracket of 39.6 and all of the Obamacare taxes, the thresholds imposed for the filing status, married filing separately, are very low. For the Obamacare tax thresholds, it's only $125,000. That means that although this affects very, very few people in the United States, it is relatively common because of the circumstances that many Americans abroad find themselves in. And therefore, it is particularly prejudicial against many Americans abroad. Now, without getting into the details of this, one of the obvious planning techniques that should be applied to get around this is for Americans who are in this situation, filing as married filing separately, they may want to try to choose to file head of household if you have kids or other relatives who are living in your household. This is not a tax preparation seminar, so we're not going to get into that, but that's something you should be talking about with your tax preparation specialist if you find yourself in that situation. Now, let's just address a couple of positives from this entire picture, and that is some of the advantages of the Obamacare legislation in terms of health insurance coverage. Americans living abroad, first of all, let's establish which Americans abroad are going to be subject to this legislation. If you are living abroad and you qualify for the foreign earned income exclusion, you are exempt from the Obamacare requirement of having to be covered by qualified health care insurance. So what does that mean exactly? Well, if you can establish that you qualify, although maybe you're not necessarily taking the foreign earned income exclusion by applying the bona fide foreign resident test or the actual foreign residence test, then you have the option of not having to have the Obamacare insurance coverage and hence are not going to be subject to the tax that would be imposed on you if you were in the United States and not an owner of qualified coverage. So that's an important note about the coverage. Now, there is a key benefit for all Americans abroad, and we've seen this here in many, many cases. Americans who have spent many years abroad, maybe during that time, unfortunately, have acquired some kind of medical issue that would prevent them from getting coverage if they return to the United States, or their rates would be very, very high. Now they can freely return to the United States, find coverage at rates that are going to be consistent with what others pay in the country, and that will be a huge advantage to them in terms of their ability to repatriate to the United States, an advantage that many Europeans have always had, of course, but until before Obamacare, this could, and in many circumstances, was a major problem for Americans seeking to return home, especially if they were in a situation where they did not have a job at the time of repatriation. So a key positive for the ObamaCare legislation for Americans abroad. Okay, now in the last section here, just the last few slides, we're going to talk about some of the investment and tax planning strategies we use at Thun Financial Advisors to help our clients manage around these new higher tax rates such that they can ultimately build wealth more efficiently in the long run on an after-tax basis. Well, given that we now have much higher tax rates on investment income, especially for people who probably in their high earning working years are going to be subject to these, if they are ever subject to them. Generally, our approach is going to be to use a variety of tools, usually retirement accounts, to reduce the taxability of investment income during high income working years and defer the taxation of that income until years probably in our retirement when our tax rate is lower because we're no longer earning income. Now, there's a whole bunch of ways we can do that, so let's talk through some of these strategies. Of course, the most obvious one is to use tax-deferred retirement accounts. Putting money into IRAs, 401ks reduces current taxation, reduces the threshold at which the net investment income calculation kicks in, and therefore not only reduces our overall tax bill, but reduces the amount of our investment income that is going to be subject to these highest new rates as a result of the changes in 2013. Okay. However, with respect to this, it can be a bit of a mixed bag because if you recall, I pointed out, especially with the ObamaCare tax rules, the thresholds are not inflation adjusted. So when we talk about deferring income into the future, we have to recognize that implicitly the thresholds above which those taxes are going to kick in are going to be much lower, 10, 15, 20 years down the road. In fact, if we think about inflation indexing and we imagine an average inflation rate of 3%, you'll see that that cuts the threshold that we talked about by half in 24 years to the extent that those thresholds are not inflation adjusted, which they are not. This, of course, implies that the ObamaCare taxes and the other taxes applied to higher income investment income for higher income Americans is going to rise over time. That means, therefore, then accounts such as Roth accounts and 529 accounts are so-called tax-free accounts increase in value, not only from the point of view of having money in them that is forever free of taxation no matter what the rate is, but they allow us in many circumstances to withdraw income in retirement that we need to support ourselves. But as a result of withdrawing money from these accounts, our overall taxable income thresholds are lower, and hence we are less likely on the rest of our income, which is subject to taxation, to have it be taxed at these higher rates we've been talking about. Another important aspect of the way you want to manage not only now but in the future is to minimize capital gains. A lot of people, especially if they're trading or they're not thinking carefully about where and when to realize a profit, will take a profit only to find out that as much as 43.5% of that profit is going to be taken away in federal income taxes. So we have to think very carefully about how to structure our holdings across a variety of different accounts. And when we need to restructure the portfolio, when we want to rebalance, when market conditions are changing and requiring us to change our portfolios, we take the investments in the places that we take the profits in the placements where they're not going to have any immediate tax consequences. So we want to be able to realize a variety of capital gains potentially in a variety of accounts, specifically taxable retirement accounts or tax-deferred retirement accounts. Another approach that can be used is to gift appreciated assets to family members in a lower tax bracket. If your kids are grown up and you want to help them make a down payment on a house, don't write them a check. Give them appreciated assets. Presumably they're in a lower tax bracket than you are. You can move that asset to them. The cost basis goes with it. They will have to pay the capital gains, but if their capital gains rate is much lower than yours because they're still getting going in life, then it's going to be a huge tax benefit for the family on a net basis. And finally, just one of the other things you need to be thinking about over the long run is most Americans will ultimately become fairly and maybe greatly inclined from the point of view of charity. And remember, assets that you have that you're ultimately going to give to charity, you want to be very careful about not realizing the tax, realizing the gain and paying the tax now, because once that asset is moved to charity, whether it's in your estate or whether you do it next year, that capital gain, that unrealized capital gain, will not be payable by the charity, and hence it will be a net tax benefit to you and the charity, and you want to be able to take advantage of that by planning appropriately. Okay, and second last slide, I know I've been going on here and I'm coming to the end, is I want to make everyone aware that we've had big changes in the estate tax also in 2013. I'm not going to go into the details of that, but the new estate tax exemption amounts of $5.25 million and $10.5 million for a U.S. Citizen couple who are married who get to double their exemption amount. This gives us huge leeway to defer assets, the gains on assets, until ultimately resolved in our estate. Okay, we've got a problem here on the. Okay, and you should understand that assets that are held to the time of your estate resolution will get a so-called step-up in basis. That is to say that the value of the cost basis of the asset will be raised to the market value at the time of your death, and hence any implied capital gain and tax liability implied in that capital gain will be eliminated. And of course, you can always use traditional estate planning tools such as individual life insurance trusts to reduce estate tax liabilities. And for those who find themselves married to non-resident aliens, especially if you're living outside the United States, one strategy we always recommend is the gifting on an annual basis of up to $145,000 of assets to your spouse. That's the amount you can gift without it being subject to gift tax. And that makes a lot of sense, especially if your spouse is in a lower tax jurisdiction. All right, and finally we're going to end up here, and then I'm going to open it up to question and answer. We're just going to talk about strategy response from the point of view of portfolio management. This gets to be the most complex. It's where we spend a really tremendous amount of time of work with our clients. And what we do is we coordinate all of the investments of our clients held across all the many different types of accounts they have according to the tax characteristics of the accounts and the investments. We focus on building strategic allocations that facilitate stable portfolios with little realized capital gains. We concentrate high current income investments in tax-deferred accounts. And lastly, we put the most aggressive investments in Roth and Roth-like accounts. And I'm going to try to illustrate some of these points. Trying to give I'm going to illustrate some of these points here. And I'm going to switch my audio off of my headset for a moment. Okay, I hope that's better now. I hope I'm coming in loud and clear. Please let me know if I'm not. I see some messages here saying that the audio is not working. In any case, moving on to this last slide, how do we operationalize this portfolio management to minimize capital gains year to year? Well, as I said, one of the things we're going to want to do is move our most aggressive investments to 529s, Roth, and Roth college savings plans. Why? These are tax-free accounts. This means that the investment income that is accrued over the term of this account is forever tax-free, and therefore we have the maximum gain accrued from a point of view of leveraging the tax advantage by getting our biggest gaining assets in those. So we want to put our most aggressive emerging markets, small caps, other types of stock-like investments into these tax-free accounts. Of course, we can't invest all of our money in extremely aggressive investments. We have to have some more secure, lower volatility investments such as bonds and real estate investment funds. And these types of investments tend to generate a lot of current income, high dividend yields, high interest income, much of which, maybe most of which, is going to be taxed at the very highest 43.6% tax rate. By housing those investments in a tax-deferred account, we avoid having our income taxed at those highest rates that we're subject to now in our high income working years. We defer the realization of that income or the taxability of that income until our retirement, when presumably our tax rate is lower. And this is a very, very efficient way to mitigate the taxation of our investment income over time. All right. These are just one of the many, many ways that we work with our clients to come up with tax-efficient investment results. And I do want to say here before we finish, in the end of the day, we never make investment decisions subservient to tax considerations. What we do is we make all investment decisions on a net-net after-tax investment outcome analysis. Therefore, although we talk a lot about tax because it's very important to the outcome, what's most important, of course, is getting the investment solutions right. And we haven't talked a lot about that today, but we have other presentations on that, so I encourage you to watch for those webinars when we talk about our investment strategy. With that, I'm going to open it up to questions and answers. Please type in a question if you'd like. I'm going to unmute everyone right now, and please go ahead with your questions. Okay, I see a question here. What is fee only? Good question. Fee only is a form of compensation which is still not widely used, but is gaining a lot. I'm going to mute everyone again so we get this feedback. Okay, fee only is the way our firm is compensated. It's gaining ground in the United States, although it's still not widely used in the United States, and it's really almost unheard of outside the United States. But what it means is that our firm, Thun Financial Advisors, has only one source of revenue. That is the fees paid directly to us by our clients. That means we don't take commissions, we don't take compensation in a non-transparent way or any other way from hedge fund groups, from mutual fund companies, from insurance companies. We don't have any agreements to sell anyone's products. The only people who are paying us are our clients, and therefore we don't have a particular interest to push investment A over investment B because we know that we have a better fee deal with the mutual fund company that provides investment A, for example. And as a result, we have only one long-term incentive, which is to see that the value of our clients' assets rise over time, which will increase our fee. And the reason we're structured this way is because, having worked in this industry for more than a decade, or almost 15 years now, what I've observed is that the biggest impediment to people, wherever you are in the world, getting good investment advice is the huge conflicts of interest that are built in to the way most people get investment advice, where brokers, salespeople, rarely financial planners or investment managers, but usually salespeople, have a high incentive to direct their clients towards certain types of investments that are not necessarily designed to be the best investment for the client, but are the best fee-generating source of revenue for the agent that is selling the product. So that's how it works. All right. I see another question here. Do you expect any changes in tax legislation for Americans living abroad? Has the acceleration of Americans giving up citizenship had any influence on policy? There's been a lot of press coverage about Americans giving up citizenship. I think it's quite clear that there's been a big spike in people giving up citizenship because of the Foreign Account Tax Compliance Act, which massively increased the cost and the burden for Americans especially Americans living outside the United States, and so-called accidental Americans, people who weren't even really that aware that they had U.S. tax obligations, to comply with what can be often extremely difficult U.S. tax rules. Has this had an effect? Well, I would simply say that speaking to a lot of people about this every week, I think the people who best understand Washington will tell you that it's unlikely to have any significant impact in terms of the chances of repealing FATCA, and that's pretty much gone by the wayside. I would say that the IRS has been fairly lenient in terms of writing up policy rules that reduce some of the burdens associated with FATCA, and we can't get into that because it's really complicated. So they are trying to do something. They certainly have heard a lot of noise from Americans abroad, but the problem is Americans abroad are not a huge voting bloc. They're not a huge constituency, and the politicians who ultimately control this process in Congress are very unaware, for the most part, aside from one or two people in the House and a couple people in the Senate who have some particular interest in it. Other than that, it is simply not on the political radar, so I do not believe that there's going to be much change. Okay, I'm going to unmute everyone again. So if you have a question, you can just speak it up or type it in. Okay, here's another question. Is the Thun fee a percentage of investment funds under management? Yes, our fees, I usually put them up in these presentations at the end. Our fees are a percentage of the assets under management that we manage on behalf of the client. Our fees range anywhere from 1.5% of the assets under management per year to as low as 0.3%, or 1/3 of 1%, depending on the amount of assets that the client has in management with us. I hope that's a clear answer. All right. I've had a few questions. Anyone else, please? Oh, here's another question. Are there downsides to 529 college savings plan? Yeah, I would say 529 college savings plans are, in general, very, very tax advantaged in the same way that Roths are, and that's why we like them and promote them, because to the extent that you hold assets within those accounts over the long run, all of the upside of the investment is going to be tax-free. And, you know, if you hold an investment, 10, 15, 20 years, you might double, triple, quadruple it, which means potentially 75, 80, 90% of the account ultimately could end up being completely tax-free income. Okay, so they have huge leverage from the tax point of view, especially if you hold them for long periods of time. Having said that, the other big advantage of 529s versus Roths is that you can get a lot of money into a 529 quickly, whereas Roths are a little bit more difficult to do. One thing we didn't talk about are Roth 401k plans, and there you have an option to get substantially more money in than just regular Roth IRAs. But 529s, you can get a lot of money into them quickly, and that's what's kind of interesting about them. It is true that there's all kinds of restrictions on 529s. 529s, when you make the withdrawals, have to be used for qualified educational expenses. And, maybe your kids will end up not going to college. Maybe you won't even spend all the money you've saved in there. You might need the money for other things before your kids end up going to college, and then you're somewhat restricted. So some of those restrictions can be burdensome. It depends on how much assets you have outside of the 529s, how many kids you have, how likely they are to go to college. We'd like to talk to people, especially to the extent that they can think really long-term, is to not worry so much about their own kids. Imagine saving for your grandchildren's college education with a 529. Maybe your kids won't use the 529 or not use it all, but you leave that money in there for another 30 years from then until they have kids and their kids go to college, and by then you're going to have massive gains in those accounts, and all of that gain will be tax-free. So it's a hugely potential tax-advantaged way to invest if you can take a very long-term outlook. But yes, it is true. 529s have a whole lot of restrictions from the point of view of the assets having to be used for only educational purposes. Okay, another question. Can a long-term U.S. expat open an IRA or a Roth IRA? Would such an account make him or her subject to state income tax? Yes, U.S. expats are perfectly welcome and able to open IRAs and even Roth IRAs. A couple things you have to be aware of, though. If you're using the foreign earned income exclusion and excluding all of your income, you don't have any income to contribute, right? IRA contributions are, and Roth IRA contributions are limited to $5,500 or your modified adjusted gross income, whichever is less. And if you remember when we talked in the beginning about adding back in the foreign earned income exclusion, which is a negative number, to get the modified adjusted gross income, you effectively, in many cases for people in lower income brackets, eliminate your adjusted gross income or make modified adjusted gross income 0. And if you do that, then of course the lower of those two limits is 0, not 5,500, and you don't have the option of contributing because you don't have any modified adjusted gross income to contribute. So that's the first consideration. The other consideration is you have to be very careful about whether or not you want to contribute to an IRA while you're working abroad. If you are in a very low tax bracket after you've taken your foreign tax credits or your foreign earned income exclusion and you don't owe any U.S. taxes, do not make a contribution to an IRA because all you're doing is double taxing yourself. You're going to put money into an IRA, you're not going to get any tax benefit because you don't owe any U.S. taxes, and then when you withdraw the money in retirement, that money will be taxable. Now, it may be in many countries, such as Switzerland or the UK, the contribution to an IRA will be, under certain circumstances, recognized under their tax system as tax deductible. And therefore, even though you've eliminated your U.S. tax bill, you may find that it reduces your Swiss or your UK tax bill, in which case it may make some sense. So the calculation of this gets very, very complicated. You have to look not only at the U.S. tax situation that the client is in, but the foreign tax situation and lots of other things. And then the Roth consideration, of course, is even more complicated because we have to choose between Roth and traditional IRA. So we have to choose between whether or not we're going to take the tax advantage now or defer the tax advantage to some point in the future. And understanding that, really the only way you can do it properly is to compare current tax rates to future tax rates. Now, most people have very little idea about what their future tax rates will be, and that's one of the things we do at Thun Financial Advisors is we do a very comprehensive financial plan for all of our clients, and one of the key components of that financial plan will be to derive as accurately as possible an estimation of future tax rates so that we can compare them to current tax rates and then make a decision about whether or not we want to make a traditional IRA contribution or a Roth IRA contribution, whether we want to make employee deferrals in our 401k plan, Roth or non-Roth, and so forth. Next question. Could the expat roll over a 401k into an IRA? There's no U.S. tax reasons why anyone cannot roll over, even though they're living abroad, a 401k into an IRA. We do it for clients all the time. You do have to be a little bit careful about what the foreign tax implications of such a move might be. All right, and if you're rigorously following the rules in a country like Germany or France, you will probably find tax advisors who say a distribution from a 401k, even for the purposes of rolling it into an IRA, is potentially a taxable event in Germany. We've gone through this in many cases. There really are not clearly defined rules regarding this for a lot of obvious reasons. For example, in the UK a few years ago, people used to say that 401k rollovers were taxable. This has since been ruled on in the UK, in which they've come out and explicitly said, no, we recognize that essentially a 401k is the same thing as an IRA. This is just kind of a change, for juridical reasons or for employment reasons, and therefore this is not a distribution from a taxable, from a tax-free retirement account or a tax-deferred retirement account, and therefore it's not in and of itself a taxable distribution in the UK, and of course it's not in the US, so the rollover works perfectly well in the UK, for example. Oh, here's an additional question I don't think I answered. Would opening up an IRA make a person subject to state income tax? I don't know of any particular connection between IRAs and state income taxes, so I think the answer to that is no. There are other things that might make a person subject to state tax even though they're living abroad. This is a very complex question. It has a lot to do with which state you were living in before you left the United States. States like Virginia and New York and California can be quite tricky in this regard, and you have to make sure you've done certain things before you've left the country to make sure that you're not going to be subject to taxation in those states even after you've left the country, even if it's for a very long time.
I have a question about your fee structure.
Excellent.
What is the threshold from going from 1.5% to 0.3%?
Right. I wish I had this up here. I could show it on the screen for you, but here's how it works. The thresholds go this way. The first $300,000 of assets under direct management by us are subject to 1.5% rate. Okay. The next $300,000 are subject to a 1% rate. Okay. The next $400,000 are subject to a 0.8% rate. So that gets you up to $1 million. The average rate there is 1.07%. And then it declines from there. I think the next rate is on the next $1 million, it goes to 0.7. The next $1 million after that, 0.6. If you get to $5 million, $4 or $5 million, the average rate is about 0.54%.
Good. Thank you.
You're welcome. If you just email me after the call, I can send you the rate schedule, the complete rate schedule.
All right.
All right. Well, listen, that was a good discussion. Unless anyone else wants to chime in with a question here, I'm going to leave it there. Of course, if you have specific questions related to your circumstances and your topics of particular interest in your country, please give me a call or email. I'd love to discuss them with you. Thank you, everyone, for joining today's call. I hope it was useful. I welcome your feedback, positive or negative on this. It's always very helpful to us. Thank you very much. I'm going to end the webinar.